Big question for today, should I be making Roth or pre-tax contributions to my 401k? It's an important question and it can actually, result in hundreds of thousands of dollars of difference in your account values depending on which you choose. So let's break that down today and help you decide what the right type of contribution is for you and your situation. So the first thing we need to understand if we're going to decide whether to make pre-tax or Roth contributions is what the heck is the difference between the two? Well, pre-tax, the name gives us a hint, but we're putting in money into our 401k before paying taxes. Congrats, you don't have to pay tax on that income this year. Well, once your investments are within that 401k, they get to grow tax-free. That's a great benefit of a 401k or any type of tax-preferred retirement account. We didn't have to pay tax when the money went into the account, and so of course the IRS is going to want their money at some point, which means that for these pre-tax contributions, when we take withdrawals from our 401k after age 59 and a half, of course, we're going to be taxed at our ordinary income rates. Roth contributions, so I wish they just called Roth after tax, but that's simply what it is. We're going to make 401k contributions with after-tax dollars that we have already paid tax on. And again, those investments are going to get to grow tax-free while they are within the 401k. And then when we take those withdrawals, because we've already paid tax, well, you don't have to pay tax twice, and we get to take those withdrawals out without having any tax liability. The real crux to this decision is asking, will I be in a higher or lower tax bracket in retirement? For some people, this may be a relatively easy question to answer. For others, it's going to be a little bit more complex. So let's take a quick look at 2021 tax rates. Well, for single filers and married filing joint couples, our first tax rate kicks in at 10% and is going to be from income, from $0 to, for single filers, almost $10,000. Now, remember, most of us are using the standard deduction. So before you even get taxed at that 10% rate, for single filers, you have $12,500 worth of income that you can recognize without having to pay any tax. So find yourself within these tax brackets and figure out what your marginal tax bracket is based on your current income. And just to give an example of how this works and why it's important to understand the concept of marginal tax brackets when we talk about 401k contributions, I'm going to walk through an example of a single filer making $120,000 gross per year. And I want you to look at this graphic on the left-hand side and think about income as if it is filling up a bucket. So that first $12,500 of income that is filling our bucket goes towards our standard deduction. So we're actually not even paying any income tax on that first $12,500 that we make. And then that next almost $10,000 we make, that's being taxed at that 10% marginal tax rate. And so on up this line. If we think about a contribution to our 401k, and were to use a $10,000 pre-tax contribution as an example, well, I can take that $10,000 from the very top bracket, and that is $10,000 that I am not paying tax on at that 24% rate. So essentially, on $10,000 going into a 401k pre-tax, that's $2,400 worth of tax savings today. That's how I want you to think about your 401k contributions and how much tax you are saving on a marginal basis. So let's look at an example. Let's look at first an example where I am in a lower tax rate in retirement than I am now. So I'm in my prime earning years. I expect to be paying a higher tax rate than when I'm in retirement and when I'm taking distributions from my 401k. So we want to make sure we're comparing apples to apples here. And if I am in the 24% marginal tax bracket, as I just mentioned, so that $10,000 contribution pre-tax, that's going to be comparable to a $7,600 contribution after tax. And if I make these contributions for the next 35 years of my career, and I earn an average 8% return on these investments, I can expect to have a pretty significant account value at the end of this period. And the key assumption here is that I am in the 24% marginal tax bracket now, and in retirement I expect to be in a lower tax bracket, so in the 12% marginal tax bracket in retirement? Well, when I compare my account values at retirement, the pre-tax account, so at that very left bar, is almost $1.8 million before I take any withdrawals. Compare that to about $1.36 million for my Roth 401k. Well, we know our pre-tax 401k, we still need to pay taxes at some point, so if I'm withdrawing that account value at the 12% rate, I end up with close to $1.6 million in after-tax value for my pre-tax 401k, and my Roth 401k value doesn't change because I've already paid taxes, so we're comparing almost 1.6 to about 1.36 million. So pretty obvious. In this situation, you're going to end up with a lot more in after-tax value by making those pre-tax contributions. So dollar for dollar, you are ending up with a higher account balance by making pre-tax 401k contributions over Roth 401k contributions. So ding, 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 pre-tax contributions win if you expect to be in a lower tax rate in retirement than you are now. All right, well, what if I'm in a higher tax rate in retirement than I am now? And this can happen often, especially maybe in our earlier parts of our career, or if we're working part-time, we may be in a low tax bracket, and we may expect that in retirement, we're going to be in a higher tax bracket. So in this case, I'm estimating that I'm a 12% tax bracket right now, and in retirement, I would be in the 22% tax bracket. So comparing a $10,000 contribution pre-tax to its after-tax value, because I'm in the 12% tax bracket, of $8,800. Well, in this case, the exact opposite is going to be true compared to that last example. So here we see that at retirement, I still end up with a higher pre-tax value at retirement. So comparing just the pure values of the pre-tax 401k to the Roth 401k, I have a higher balance in my pre-tax 401k. But once we take taxes into account, the after-tax value of the Roth 401k is going to be much higher because, again, that pre-tax 401k, we have not paid taxes. And when we take those withdrawals out, we're taking them out at a rate that is higher than the rate that we would have paid tax at earlier on. And so, again, emphasizing that this difference can be huge. If we decide to make the right types of contributions at different parts of our lives, this can result in a huge net difference between our pre-tax contributions and Roth contributions. So really want to emphasize this is something that's going to change throughout your career and throughout your lifetime, and you want to be constantly evaluating this decision as your income changes. Do you expect to be in a higher tax rate in retirement, or do you expect to be in a lower tax rate in retirement? For most of our careers, we generally expect that we're going to be in a lower tax rate in retirement, but certainly there are plenty of situations in which we might actually be in a lower tax rate now. So I want to wrap this up with just a couple of rules of thumb to help make this easier. Obviously, I don't know you, and I don't know your individual tax situation, so this is just going to be general advice. But if we think about somebody in the 10 or 12% marginal tax bracket, there's a very low likelihood that you're going to be in an even lower tax bracket in the future. So generally, you want to make Roth contributions if you are in the 12 or 10% marginal tax bracket. On the opposite end of that spectrum, if you are in the 32, 35, 37% tax bracket, congrats, you're making the big bucks. But that also means that you probably want to save as much on taxes as you can now, and you probably want to put those dollars in your 401k pre-tax. And then lastly, if you're somewhere in the middle, this is going to be a little bit trickier where you want to estimate, do you expect to be in a higher or lower tax bracket in retirement? And if you're unsure if you're in the 22 or 24% tax bracket, and if you think you might even just be in the same tax bracket in retirement, it might make sense just to split these contributions up evenly and go 50% of your contributions to pre-tax and 50% of your contributions as Roth 401k contributions. Well, what if you are already maxing out your 401k contributions of $19,500 a year? Great work. If you're over 50, you get an additional $6,500 that can be contributed to your 401k. But this might change how you make this decision of pre-tax versus Roth. And it especially changes how you want to think about where to save and if you have any additional dollars beyond the 401k that you want to make sure you're saving in the most tax efficient manner. So that's the question I'm going to cover in one of my next videos, and I'd love to hear in the comments below any questions, any topics that you'd like me to cover in future videos.